For more on markets and how they're handling inflation, as we've been talking about, we're joined by Kathryn Rooney Vera. She's Chief Market Strategist at StoneX Financial. Let's talk more about this dynamic, because at some point that bond market havoc, if you will, it's been very volatile under the hood, is going to impact stock market performance. But at what levels do you think that would happen at more?
Well, I think if we get some sort of trade war, then that would inherently affect multinationals, which are a very high weight in the S&P 500. So a strong dollar, high tariffs, that would certainly affect multinationals. But maybe I'll add to what your previous guest was talking about. And I think it's an interesting point. A couple of things. I think one, there are ways to get deficits in line without soaking the rich. And I would suggest reforming entitlement programs would be one of those. And in fact, the U.S. government, in terms of federal and state employees, is the largest employer in the country. So it's pretty relevant, 20 million plus people. And I would add a final point, Shanali, which I think is particularly interesting, which is my contention is that the U.S. Treasury yields are moving higher, not because of chaos or Donald Trump, but rather because I think we're at the end of secular stagnation, or this global savings glut. Larry Summers called it secular stagnation. I think it was Greenspan called it the savings glut. Investment now as a percentage of global GDP is very high. It's the highest we've seen, 27%. And I think that the fiscal pass, the profligacy pass, the bond markets have up to this point given the government has come to an end. So my suspicion is that term premium and the 10-year yield move higher if we don't get spending under control and if the size of government is not decreased. So for that reason, Shanali, I think that poses probably the biggest threat to the equity market. So yes, tariffs are a threat. We saw in 2018 with Trump 1.0, we've seen this movie before, tariffs were imposed, far fewer than what he had threatened. But we saw in 2018 about an 8% drop in the S&P 500. We can expect a similar occurrence, but I would argue that if we have a blowout of the fiscal deficit, that's even worse than across the board tariffs affecting multinationals.
Well, it's interesting. It's a risk that I think a lot of people don't quite understand what the ultimate ripple effect will be. I go back to Ed Yardani's note over the weekend, where they say that right now it's not an imminent issue, but they say to ask again if the yield jumps above 5% with attendant widespread fear that it's heading towards 6%. Now, that kind of 5% level, at least in the near term, there are more and more investors voicing fear around that level. I can't imagine what 6 would mean. What would 6 mean?
Yeah. Look, I think there's a very good chance, Shanali, that we hit. We're at 4.5 now. We probably break 5 at some point in this year. And I think there's a real threat of 5.5%. If we hit 6, then we're talking, in my opinion, I think we see a meaningful correction in the U.S. equity markets, because, of course, then equity risk premium pales in comparison to what you can get for a risk-free asset. So when you're talking about exposure, and I travel all over the world, I've been at StoneX now almost 2 years, and I've done 50 trips. When I talk to international institutional clients, Shanali, it's fascinating, because you can talk to life insurance company, pension funds, inherently risk-averse investors, and these guys are long dollar assets. They're long equities. They're long tech. They don't want to hear my thoughts on how to protect profits. They want to hear about what are the next Mag 7, what's the next big thing. So there's, in my view, a big potential for a correction, and that's why I'm recommending investors protect their profits, not liquidate them, because I do think that this year is going to be a good year for the U.S. economy, not a bad one, but protect those positions. And there's a lot of interest in private credit. There's inordinate interest in alternatives, and that's because the 60-40 correlation between stocks and bonds has wholesale gone out the window. So
I want to double down on the point you're making about the next Mag 7, because if you look at the Mag 7 performance this year, it's been sluggish at best. You have the NASDAQ 100 largely outperforming what you saw in the Mag 7. It's up more than 5%, beating out most major indexes, but you also still have a lot of the high flyers in that index flying high through the course of last year, too. So pretty bid up. Palantir's the best performer this year. Constellation's the third best performer. Does that worry you, the concentration risk, even outside the Mag 7?
Well, there is concentration risk in tech as a sector, and that's why I recommend buying protective puts on the technology sector. So I do think there's a risk there, especially if we do effectively get into a trade war. Then industrials and tech are, I would think, the most vulnerable. And I'll add to that, does concern me because if I'm right and we get a reacceleration of the U.S. economy and potential overheating of the U.S. economy, remember, Shonali, this is the fourth consecutive year, if my estimates are right, and the U.S. grows 2.3% or more. This will be the fourth consecutive year of above trend growth with a positive output gap. That in itself is inherently inflationary. And the sectors that are most vulnerable to still high rates, or even, God forbid, the Fed having to resume hiking rates, is effectively tech. So I do think there's opportunities to reallocate assets to potentially underperforming sectors or defensive sectors. And if we get an all boats rise year, then I think you should be in healthcare. I think you should be in utilities, which was my top pick last year and a very top performing trade. I think you should be in staples, more domestically oriented sectors.
Kathryn, we thank you so much for your time today. That is Kathryn Rooney Vera with StoneX Finance.